From New York City for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. Coming up, conflicting economic data. As consumer sentiment rises, housing starts fall. The data come 1 week from Powell's Jackson Hole comments, setting the stage for an expected September rate cut. And U.S. junk yields hit the 2024 low as that Fed easing looms. We begin with the big issue, reading this week's economic data tea leaves.
We're moving in the right direction.
I think it's pretty good news. For now, we're in good news is good news land.
So long as we have signs that economic growth stays above zero, we're in that soft landing zip code.
So I think this is definitely the inflation report that the Fed is looking for.
They want to cut rates. They're probably going to cut rates in September because they've opened the door wide enough to, bring a Mack truck through.
Either way you want to put it, that's going to be bullish for bonds over time. But we don't think that right now the economy is screaming for the rate cuts.
We think 25 is the right first step towards easing policy.
So our base case remains for a 25 basis point rate cut in September.
I think they're in a fine place at this point in time, and Chair Powell at Jackson Hole can help guide us on how they're thinking.
It seems to be so difficult to read this economy right now, as evidenced by the two-year yield. Let's look at the two-year yield over the past 11 days. That's right, 11 days. As John Authors of Bloomberg Opinion says, what a strange route it's been. As you can see, that was the jobs report. We were down about 20 basis points. We're already up to practically where we were before that jobs data, very close to 4.15 on the two-year yield. And that's in spite of very mixed economic data. And then the market is having difficulty pricing in how many Fed rate cuts we're going to have by the end of the year again, right? So remember, after the economic data, we had the likes of Michael Feroli from JP Morgan Chase even saying that we might get an inter-meeting cut, and we definitely get 2 cuts in September and in November, and then more after that. Well, this is how markets have been reacting. As you can see, markets are pricing in fewer than 100 basis points of cuts between now and year end. And just in the last few days alone, we've had this change in market pricing. And I'm sure it's not over for the year after all. We're supposed to be in the quiet months and in the quiet weeks of August. Well, this week we caught up with former Chicago Fed President Charles Evans about what the Fed should do next.
Is in an okay place right now. I think that they have spent a lot of their time indicating that they need confidence that inflation is going to be on a sustainable path to get to 2% inflation. And I think that's a stiff performance bar. I think it is time for them to, really start talking more about how they're going to act and actually act.
Joining us now is George Bory from Allspring Global Investments and Robert Tipp from PGIM Fixed Income. Thanks to both of you for joining. George, let me start with you, because earlier in the summer, you were looking for just 1 rate cut by the end of the year. It's so difficult right now to predict how many rate cuts we will get. What is your current position?
Yeah, hi. Thanks for having me on the show. The current position is that we will likely get 1 rate cut, and we're likely to get it in September. And now the probability for further rate cuts has gone up, as many people have pointed to. The data has softened, but it's still a far cry from kind of recession-like outcomes. So the Fed has a lot of latitude to basically go kind of with the pace of the economy. It's very clear that the bias is to cut rates and that the data is sufficient to justify that rate cut. The vol shock we saw a couple weeks ago, clearly got people very excited to expect big rate cuts very soon, very fast, and perhaps pretty aggressively. We haven't moved away. We haven't moved in that direction. If anything, the Fed still, we think, is going to be fairly patient, and they can be, because, as you pointed out, the data is mixed. It shows some degree of a slowdown, but still not any imminent collapse. We saw retail sales look pretty good. Inflation data is still a little stickier than perhaps the Fed would like, and confidence is looking good. So it's a little premature from our perspective to suggest that the economy is going to suddenly roll over and that the Fed is going to have to cut fast and furious to protect against that downside.
Yeah, that move index still just a little bit elevated at 103. It had been just above 80 back in May, but it's definitely far off its highs. Robert, let me come to you and ask you about where you think the preponderance of data is falling, because even today we had very mixed data with a consumer that seems to be quite confident about the future, but still anticipates that inflation will be a problem.
Right. Well, you know, consumers have been scarred by the high rate of inflation. But, you know, what we're seeing in the inflation data that, you know, gives us confidence that the Fed will be cutting is, number one, the fact that there is some moderation in economic growth, and the Fed believes they are restrictive. So that creates an a priori for them that if they have the latitude to cut, they should do so in order to extend the life of the expansion and to maximize employment. On the inflation side, things are really cooperating there. The numbers at a headline level year over year are not at target, but there's a good breadth of, say, the consumer price index away from food, energy, shelter, that core, or even if you just take shelter out from the headline, that is very well behaved at target, suggesting that the only thing holding up the rate of inflation as far as the CPI is concerned is really housing. And with more multifamily supply coming on, we're seeing variability in rent rates, and all of that points towards inflation getting to target. So I think that creates the backdrop for the Fed to cut in order to extend the expansion. And inside the employment numbers, they're seeing some alarming signs there that their restrictive stance may create more of a slowdown than they want. So I think everything's really come together for that rate cut path.
Sure, but Robert, remember back after the July jobs report, which came obviously in early August, people were basically fainting at the idea that the Fed had made a mistake, that it was too late now, that, you know, employment is a lagging indicator and now we've gone and done it. Is this repricing that we've seen the market saying to the Fed, okay, you did get a passing grade, you haven't quite made a mistake just yet?
Yeah, I mean, I think the Fed has done a really good job. Chairman Powell's on his way to achieving a second soft landing. That's been the a priori, is that as soon as they had the latitude to cut, they would move towards doing so. They're moving towards doing so. And the payroll growth is strong. The thing that's pushing up the unemployment rate is the growth in the labor force. So this economy has the potential to grow faster. They want to tap into that, extend the expansion, cut rates. The pace of cuts priced into the market is aggressive, though. And at every soft data print, every low inflation print, the market has moved towards a kind of the better part of 2% of rate cuts in the next year. And I think the reason for that is really investor positioning. You know, investors have had a big increase in their wealth through home prices, through equity values. Money market balances are incredibly high. The only thing investors have not really locked in is the stream of income. And that's why we're seeing this asset allocation trade, and it's keeping the Fed pricing on the aggressive side.
Well, George, you guys at Allspring have been on this for a while. You have been diversifying duration and where you actually invest. And I'm curious as to where you stand now that we've had so much repricing and repricing and repricing. Earlier today, for example, Noel Dixon from State Street said he wouldn't be comfortable recommending the 10-year duration until the 10-year yield is back above 5%. Where do you stand on what's the best duration for somebody to go into right now?
Yeah, a central message from us has been diversify duration. That can be viewed as simply as just extend, adding duration, as Robert mentioned. Sort of those coupons, those income streams had been fairly attractive earlier this year. Yields have come down quite a bit, but are still fairly attractive. In real terms, we still have fairly strong positive real yields. And so we still would be willing to extend a little bit of incremental duration. Our view is that the 10-year yield between, say, 3.5 and 4 is going to be closer to fair value. So, I mean, hoping that yields get up to 5 might be a bit of a stretch. But we think if with 10-year yields in and around 4%, we still think that's a pretty good value area, especially for an economy that is decelerating. And as Robert mentioned, with rate cuts likely to come, the sort of the overbought part of the market, I think you had a chart of it earlier, was the 2-year part of the curve, which rallied very aggressively, and we were willing to pare back some exposure around the 2-year as it rallied to its lows. But now it's coming back up and more in line with a more measured pace at the front end. So there is lots to do as it relates to duration. Our bias is to position simply for steeper yield curves, which we think are coming. You can do that at the very front end of the curve. You can do that at the longer end of the curve. But steeper yield curves, by and large, are a nice way to play an environment where we still have good economic growth, albeit decelerating, and a Fed that's biased to cut rates. And so from that perspective, you can really set up a nice portfolio structure that both captures those current yields and incomes and is well positioned for the current economic environment.
Yeah, Robert, I mean, the steepener trade had been the all-in trade, right? And it just seems in the last few days that it's more the short end of the curve that's now attracting money. Is George right? Is it a mistake to maybe be attracted by that when you could lock in your money for 10 years, even now at 390?
Well, I think there's elements of truth in both of those. I mean, we're past the peak for interest rates for this cycle. So being in the market, having a full market duration or even a long duration over the long term may work very well here. Problem is the curve is negative carry. It is an inverted curve relative to the Fed funds rate. And if you are extending duration, you need to be right, that the forwards will be realized and the Fed will cut at least as fast as what's priced into this market. So I think there are opportunities to place, the exposure of the portfolio along the yield curve to avoid that roll up, to maximize the yield. Another way to do that is through spread product. Those curves have different shapes than the Treasury curve, than the SOFR curve, than the Fed funds rate swap curve. And I think it is very important to avoid the roll up on the yield curve to maximize yield so that you can lock in the income stream for the long term. But avoid the negative carry and negative roll-up aspects of the steep inversion that George mentioned at the front end of the curve.
All right, thanks to you both for such wonderful advice today. That is just now Robert Tipp of PGIM Fixed Income and, of course, George Bory from Allspring Global Investments joining us as well. Up next, the auction block. JetBlue raises billions of dollars worth of bonds a day after getting downgraded by the ratings agencies. We dig into credit next. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where credit issuance volume withstood the wave of U.S. economic data this week. High-grade sales were $29 billion, hitting the high end of the forecasted range. The big highlights included Eli Lilly, Bank of America, and Caterpillar. Historically, end of August is sparse pretty much for sales, but this year, well, it could be different with about $20 billion of new sales expected next week, mostly Monday and Tuesday. Over in high yield, August has seen $17 billion worth of sales, up more than 40% compared to the full month of August in 2023. This comes as the cost of capital drops, with yield to worst falling to a new year low. In particular, looking at JetBlue, it sold $2.77 billion of bonds and loans, and that was just one day after being downgraded by both Moody's and S&P. The transaction is backed by JetBlue's loyalty program, a move several peers have done in recent years. And sticking with credit, Invesco's Matt Brill says there is still investor appetite.
High yield will come back if you get a little more stability in the market. I think just given the shock that you saw, it's sort of hard to jump right into the high yield market. But overall, once you stabilize and you look at high yield, where it's trading from a yield standpoint, it's going to look pretty good if you believe that we're not heading into recession, which we still need to see a few data points, I think, to get people to believe that. But again, go back to investment grade. It's mainly been an institutional buying spree for the last several months or really several years. But within the last week or two, we're starting to see the retail market pick up.
And JP Morgan now saying investors buying high-grade U.S. corporate bonds when spreads are widening have made a profit within 3 months about 70% of the time. So that sounds fairly attractive. Let's get to our panel. Stephen O joins us of PineBridge, and Meghan Robson is also here with me in studio. She's from BNP Paribas. So Meghan, let me start with you in studio. What is the appetite when it seems like there's risk out there? We're not even quite sure what the risks are yet if you look at the economic data, and spreads are not particularly wide.
Great question. Thanks for having me, Vonnie. So we did see the biggest sell-off in credit in the last 2 weeks as we saw some of that volatility. A lot of that has recovered, but spreads are still sitting wider than the tightest levels that they were for several months. So in our view, there is still a bit of spread upside to capture over the next couple of weeks as we head into August. I think there's a few supportive factors. You mentioned supply. We still do have $20 billion to get through next week, but it's actually a lot less than earlier this month when it was 30, 40 billion per week in investment grade. And then secondly, positioning, investor positioning was very extended in the U.S., and that happened to come down with the sell-off in credit. So I think those two factors, along with some stability and growth, are going to be positive for credit.
Stephen, on that perceived investment risk in the corporate bond market, we're at something like 52 basis points. I mean, it's basically no risk whatsoever. Would you agree with that market assessment?
I think the market is pricing in both the economic soft landing to a glide path scenario with accommodation coming from the Fed that will be supportive of credit going forward despite the slowdown. And furthermore, and probably more importantly, the fundamentals of the credit backdrop is really fairly constructive going into this. And so when you take a combination of those factors, valuations are still tight despite the widening that's taken place. But we believe that the tight valuations are fair to both the credit outlook as well as the macro outlook, because we too do not believe that there will be a recession forthcoming in the future. And then for much of this year, the credit spreads have really traded an inverse relationship to where the Treasury component has been. And if you look at the price levels, that's been more steady. And in fact, credit has been a much more stable part of the market than Treasury markets for this year.
Okay, so quite a sanguine outlook from the markets and from those market participants that we have in studio. But at 7.5%, Meghan, is that pricing risk correctly in the high yield market? And would you be buying at those levels?
So I think high yield, there definitely is a story of bifurcation. So we do think that in a soft landing, our base case, double B, single B credit can hold up very well and still offer attractive risk reward to investors. However, rates are still high. We have seen a pickup in idiosyncratic issues. And so we're much more cautious on the more highly levered companies, things like triple Cs, where you have seen larger drops in certain names, and we still do think that you're more vulnerable to an earnings slowdown as growth decelerates into the second half.
Yeah, Stephen, you must be keeping your eye out for some kind of dislocation in some of the markets somewhere, right? You don't want to put all your cash to work right now. I presume you have some fire that you're holding back. Tell us where and where you look first thing in the morning in case something has changed.
Well, I think we've been operating in an environment where nothing has been particularly cheap across the spectrum of, credit and fixed income markets. Going back to where we did see value, even though high yield represented very attractive yield, we really saw no opportunity for price appreciation, and the best outcome was something resembling a coupon yield type rate of return. So in that regard, one of the places that we did see value earlier this year in the below investment grade arena was in Asia high yield, and we were overweighted toward Asia from a geographic standpoint. And to be clear, the Asia exposure was not about a China recovery, but really the strength of Asia corporates in high yield outside of China in particular. And a lot of that spread opportunity has played it out. But where we sit today, we think that yields are fair within the high yield marketplace, but not cheap to continue to add to exposure. And I think in a market like today, it's prudent to maintain some level of small dry powder. And one of the places that we're doing that is in high quality investment grade CLO tranches, where if you look at AA tranches right now, the yields that you're getting are equivalent to double B high yield with much lower risk profile. And so it's a good place to sit when you don't think there's going to be price appreciation, but it's about carrying the short term while having the dry powder.
Fascinating. And Stephen, can I just push you a little bit on your ex-China Asia trade? Would that have been Japan or in India, for example? And how did the movement in the yen and the perceived expected movement in the yen for the next few weeks, how would that change your outlook on those kinds of bonds?
Well, first of all, when we take exposure outside of the U.S., we don't take currency risk. We're taking hard currency exposure because anything in currency will overwhelm what you do on the credit component. And it's been fairly broad across the spectrum, but it has been in markets like India, where we like the India's renewable sector, parts of the Indonesian commodity component. So a fair amount of it is in the higher growth South Asia economies, but there's also been some targeted broad Asia Pacific as well, including Australia and Japan.
Meghan, I want to ask you about opportunities outside the United States, if you're taking advantage of them now or waiting, or how you've been doing that.
We have had an overweight earlier this year to Europe over the U.S. A lot of that has transpired in Europe catching up to the U.S. So we still see value now between U.S. and Europe as more neutral. I would say, though, that there are slightly larger risks in the U.S. So we have the election coming up. We do expect that the Fed will start cutting rates in September, but over in Europe, you've already started the monetary easing cycle, so that's another advantage. And then positioning in Europe is much more neutral, a neutral level following the recent volatility and sell-off, whereas U.S. is a bit longer. So I think on the margins, still risk-reward looks slightly more favorable in Europe, but not a high conviction view for us.
It does seem like everyone's expecting the Fed to go by 25 basis points. You have to wonder what would happen if there was suddenly a 50 basis point move. But we're not there yet, so we'll wait and see. Our thanks to both of you. That here beside me is Meghan Robson of BNP Paribas, and Stephen O joined us from PineBridge as well. Thanks to you both. Still ahead, the final spread. The week ahead features the DNC, of course, more earnings, and Fed Chair Jerome Powell at Jackson Hole. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield, and it's time now for the final spread. The week ahead, coming up Monday, of course, we have the Democratic National Convention beginning in Chicago. Not only that, but we also have some earnings. Estee Lauder and Palo Alto, for example, both reporting. A read there on the consumer as well as on the chip industry. And then continuing consumer reads with Lowe's and Toll Brothers on Tuesday. Wednesday, we'll get the FOMC minutes and Target and Macy's earnings. So a lot to digest on Wednesday. And that's all before Thursday's acceptance from Kamala Harris at the Democratic National Convention of the nomination. We'll also, of course, get U.S. jobless claims on Thursday and existing home sales. And then Jackson Hole, Fed Chair Jerome Powell will deliver remarks, and we will be able to bring you all of those. And of course, there's always the possibility that geopolitics upends everything this week. Just saying. This has been Real Yield on Bloomberg.